Let's go over to Tom Piotrowski on a busy Wednesday morning. What more have you got to add this morning, Tom?
Oh, Pete, only that the ASX 200 is going to kick off with a slight loss this morning, down by about 1/3%. So I suppose that is a reflection of the caution that we've tended to see for Northern Hemisphere markets in their just recently completed sessions overnight. The next couple of days brings with it a window of a lot of central bank activity, and at this time tomorrow morning we'll be discussing earnestly the outcome from the US Federal Reserve. Although, having said that, there is an overwhelming belief that the US Central Bank will be cutting interest rates tomorrow morning by 1/4%. It's not just a question of that. There's a firm conviction that over the course of the medium term, we'll see as much as another 1.5% coming off interest rates. So this is quite a high bar for the Fed to meet in terms of those expectations. So in that context, sellers just had the edge. You had the Dow Jones finish with a loss of 1/3%. The Nasdaq and the S&P 500 each shed by around 0.1%. It was interesting to note, Pete, that last night we saw some rather strong retail sales numbers for the month of August, and that really flies in the face of the narrative most recently in the US that a slowing employment market might be impacting the consumer. So that was a little bit of a surprise, but it didn't sway anything in relation to the conviction around that rate cut that's expected from the Fed. Elsewhere, all prices have bumped higher for a third consecutive day. So they're up in the order of around 2%. So we've seen more attacks from Ukrainian forces on Russian production facilities, and at the margins, that's pushing some prices up. So energy stocks did quite well in Northern Hemisphere trade. That should be a similar case as far as the local picture is concerned. Gold's still flirting in with the neighbourhood of record highs, up by 1/3% at $3,692 per ounce, and the Aussie dollar is trading at 66.8 US cents.
Lovely stuff. Tom Piotrowski, thank you so much.